Property Finance Uncut, the must-listen podcast for anyone with a mortgage. Find out the truth about what Australia's lenders are up to and how to make sure you're in the best possible position when it comes to your property finance.
That's all we want to be, is in the best position when it comes to your property finance. Phil Tarrant, host of the Smart Property Investment Show. Welcome to Property Finance Uncut. It's the day I thought, it's really funny. Just the other week I was thinking, I think this show's done its run. There's nothing left in the tank. We don't really talk about interest rates anymore. We've hit the peak. That's it. So what are we going to talk about for the next 12 months if nothing really changes? And I was thinking, okay, well, what's next for talking about finance on the Smart Property Investment Show? Guess what? It's not really a curveball. The Reserve Bank of Australia whacked at the time. It's un-Australian to do it on Melbourne Cup day. The 25 basis point rate rise. Everyone is, I imagine right now, the numbers have just come out as a race about to start, sipping on a beer, thinking that might be the last one they're going to have all day because things just got a lot more expensive. It's a bit depressing, but I will say it. I said there'd be one more. So Here it is. Paul Glossop, CEO of Finni Mortgages, finni.com.au, comes in every single month to give us the scoop and the skinny. I don't know why you're sitting there. You're probably one of these people who have rushed back from the pub going, oh, God, I didn't think this would happen. Why? I just want to be back having a couple of schooners commiserating on not only a loss of some cash flow because the interest rates are going up, but probably that nag you put your money on didn't come up either. How you going, mate?
Mate, I'm good. The nag has not yet run, but I've definitely got the incentive is on the Irish horses apparently this year. But Matt, I'll tell you what, the bookmaker share prices are probably going to be struggling a bit with a bit less money in the kick for any mortgage holders in Australia, unfortunately, albeit likely to be relatively short term, but nonetheless, it's going to put a dampener on the Christmas spirits, I think, for many mortgage holders across the country.
And this has to now be the last one. I've been looking at a lot of the data around this. I'm not an economist. I'm an armchair commentator around the Australian economy. I probably know a little bit more than most, and I get access to people to ask some questions around it. I was 50-50 on this. I thought there'd be another rate rise. The rest of the world, the rest of this sort of Western central banks are going the other way, right? They're already thinking about sort of tightening. And some of the mail coming out is, well, maybe we should have done a little bit more a little bit earlier. We haven't had a rate rise since June of this year, but this is the 13th time in 19 months, Paul, that we've had a rate hike from 4.1 to 4.35. That has to be now the terminal rate. That's 400 basis points since May of 2022. So there's a lot of people now going, oh, God, how much more? Like, what do you need? And remember, interest rates really only affect those people with mortgages, right? It's a bit of a blunt tool and a blunt instrument. But, a lot of the commentary coming out, and even Westpac this morning was saying, well, Australians can they can weather this. They've got a little bit more left in them. They reckon Westpac, they've got 57 billion bucks in offsets cash sitting in their accounts on mortgages. So they're going,
yeah,
it's going to be okay.
And you put it in perspective, that they've got a very decent wedge of all Australians' cash sitting in reserves right now. So they do get a very good cross section as to how well are we prepared for higher interest rates. And I mean, I think to your point a second ago, mate, is that it's a pretty blunt instrument, unfortunately, because typically the people we're trying to stop spending or curb spending are the people potentially with very little, if not no mortgages. And unfortunately, when interest rates increase, they actually benefit these people more so than they are a hindrance to those who are in the early stages of holding a mortgage and are probably going to see that their belts are definitely tightening. These are the younger people with the higher mortgage LVRs, etc. But when your interest rates go up, your term deposits increase. If you're holding a property as an investor, unfortunately, renters are going to see this passed on to them again. We've got no additional supply coming out of this, and if anything, this disincentivizes developers to want to build more assets because ultimately holding costs and funding costs are more expensive, and here the cycle continues. So it's an interesting one.
And look, Michele Bullock, the RBA governor, relatively new to the job. This is the first time she's actually had to make a decision when it was a sort of 50-50. Some people were saying 70-30. Who knows what the odds of this coming up were, but she's actually had to make this call. And one of the things, no doubt, the governor and her team were thinking about is that they might make that decision today, but the ramifications of this probably won't be seen, or the impact of this won't be seen for many months moving forward. And this is the tightrope they walk. Will this curb spending over the Christmas period? I tell you what, the retailers don't want that, and
no.
Apparently that's sort of connected in with the integrity of the economy. So these aren't light decisions, because you put the handbrake on people's ability to spend, and the argument is that inflation continues to be at levels that they're not comfortable or confident with right now. The issue you have is that if that handbrake is pulled on, and it's pulled on too hard and for too long, you're going to stifle growth moving forward. And who knows, mate? You just mentioned a couple of things there. We mentioned, I caught up with the Shadow Treasurer recently, and he said, Phil, mate, we're already in a recession. We're in a recession. The only reason why we're not is because of immigration, right? And to your point, if they're not building new properties, the strain and stress on rental stock, which is a contributor to inflationary pressures, rents are going up, and that contributes to inflation numbers, along with what we've seen recently, the war in the Middle East and rising energy prices. It's complicated. So what do you do about it, mate? You can't do much about the decision today. What you can do about it is what you choose to do about it, and how you choose to manage your mortgage more effectively.
Exactly, and that's kind of the point here, is that we can use about this nonstop and say, well, here's this and here's the information there, and New Zealand's in a recession, Germany's in a recession, looks like the US is heading towards potentially going down that pathway with another 0.5% increase to their unemployment rates over the last 6 odd months. And we can talk about all this and what's influencing it, what we can do, what the government should or shouldn't be doing. We can't change it, unfortunately. Sounds like you can, Phil, if you're talking directly to the Treasurer. Maybe give a hot tip for us average punters that we want to have a bit of spare cash to put.
Mate, don't worry, Phil Tarrant's looking after the investors. Phil Tarrant's looking after the investors.
A man of
the corridors of power.
Nothing happens.
Nothing happens with investors in Australia without my steady, quiet hand.
I don't doubt it. But look, I think if we look at the upsides here, and we just had this conversation this time last year when we were right at the early stages of these interest rate increases happening, and asset prices were actually, they were really reducing quite quickly then. Lo and behold, here we are with, as you said, mate, 13 interest rate increases in less than 2 years. However, we're now at the point where asset prices, residential property in Australia, is back to essentially where it was at its previous peak. So it clearly isn't the only lever, and it isn't a lever that essentially governs the price of assets long term. To your point of all this immigration that's happening and will continue to happen, that needs to happen to bring unemployment up, ironically, because we need to see that put more pressure on the labour market. But what can people do? Well, if you actually already hold a property, and if you're I guess tuning into this and concerned about mortgage rates, it probably tells me that you hold a property because you're concerned about what the mortgage is. The good news is your actual value of your asset isn't plummeting, so that's a plus. And that is not necessarily a mechanism of interest rates increasing. That's a mechanism of demand for property in this country. And that's not going anywhere anytime soon. So then the next question is, okay, well, what can you do to better your situation to actually, reduce your ability to actually have lower mortgage rates? And that typically means you need to be more attractive to more banks. So we talked about this off air, Phil, and saying, what are some of the levers that a lot of either owner-occupiers with a mortgage or investors with a mortgage or a combination of those two people can do? What are some of the main things that they can do to hopefully get a better rate in this higher interest rate environment? You mentioned credit cards. Credit cards typically is something that we have, and a lot of the time we have unnecessarily. And having a credit card that's got a higher limit, and I'm not going to have this as a banning on about tear up your credit cards, but it actually means that you're going to be at a higher risk category. So therefore you potentially aren't able to access better rates, better loan structures. And then other things that people can start to consider doing is really shop your interest rate around now. This is shopping time, because we saw this only last week. Westpac came out to commercial investors, where they came out with if you're a small, medium business owner, they came out with a new product, which we haven't seen for years and years, which is essentially a zero deposit opportunity to go and borrow money to buy an investment in the commercial space if you're a small to medium business owner, as long as you qualified from an actual serviceability rate. So we're seeing the actual banks are really competitive. They're offering products which we haven't seen for a long time. Tells us, to your point, mate, that there is a lot of incentive for banks to lend more money. You need to shop that around, and you need to get in touch with your broker, because they are coming out of the woodwork with different opportunities right now.
Yeah, and I've been sort of telegraphing innovation. It's been happening left and right as we've gone through this rising rate environment, and some of the innovation is sort of the curbing of buffer rates for established lending and all this sort of stuff. On the commercial side, the fact that Westpac is throwing down the gauntlet, providing those products. Number one, they must see inherent value in commercial assets. I doubt they're probably willfully giving a lot of money out for the office space stuff, but they'll be discerning about which assets they will lend against. Innovation is taking place, and let's remember, while Australians with mortgages sitting there going, "Oh, how am I going to find another X amount of money every single month to service my mortgage?" The bankers are popping champagne corks going, "Hey, our bottom line just got a lot better because we've just been able to raise interest rates." Now, they'll have an argument around the cost of funds are increasing and this, that, and the other. They love it, right? They're very good at scripting the narrative around the realities of being a banker. But look, the last reporting season, most banks aren't struggling on the profit side of things at the moment.
Record
right?
profits.
So, they're doing okay. So I'd like to see some innovation out of the banks to give good, honest Aussie investors a red hot crack at trying to create wealth through property, Paul. But I had a really good chat with, I don't know, you listened to it, with one of your mortgage brokers, Eva, on this show a little while ago. And this is the point, right? You can sit here and be armchair economists and talk about the ifs and whys and whatnots of geopolitics impacting inflation, impacting what immigration is doing, impacting whatever. Look, you can't do anything about it. You just you're on for the ride. It's how you choose to drive on that ride is how you're going to be the best place to be an effective property investor, or making sure that your owner-occupied home loan is good. We spoke about being a better borrower. So how do you actually reduce your debt levels, and how do you actually position yourself to be able to take on more debt, right? So how to maximize your borrowing, essentially. And maximizing your borrowing might just be for the purpose of refinancing. You want to position yourself better for banks. Or it might be you want to aggressively use this opportunity to grow your portfolio. And you spoke about, property prices in general are back to where they were at the start of this property downturn. And you need to go back in time and know that property ain't a bad horse to back, pardon the pun, it's race day, for creating wealth in Australia. It does fluctuate, but inherently it goes up in value on a good basis. So maximize your borrowing right now. How do you do that? Go and listen to this podcast, but it's about balancing your own P&L. It's about trying to generate more money or trying to reduce costs. And we spoke about how you generate more money, and that could be through like side hustles and this type of thing, getting a pay rise from your boss, maybe taking on another job, all this sort of stuff. But where you can have the biggest impact is reducing, number one, you spoke about it, your access to debt, and number two, your cost of living expenses. Banks will look at typically 3 months of your spending to determine whether or not you sit within their sort of hem range, which is the standard way they measure stuff. They go, nah, you live a lot more fancy than other people, so therefore we're not going to lend you as much money. So reduce your debt, reduce your spending, get lean, get fit, and you can capitalize on that. But you said it right, only really a mortgage broker is going to be able to help you find the right home loan at the right rate for your needs. And I know your team I listen to your adverts all the time. Access to 70 lenders and all this sort of stuff. By the way, it's a good business you've got. I invested in it. So there's a disclaimer, as everyone knows. But, it's a good place to start.
Absolutely, mate. It's funny you had a smirk on my face when you talk about getting lean, getting fit, and your last 3 months of expenditure, or your P&L as a household, is typically what's going to determine what is going to actually fit on the sheets when we're lodging to the banks to figure out what rates you can get. It actually reminded me of a client, and I'm not going to name a client. They may or may not be listening, but we, as part of when you're having to assess their expenditure, looking at credit card bills, a client of ours, believe this or not, individually had over $9,000 a month in McDonald's.
Really?
And you're talking about getting lean, getting fit. And for me, I was thinking that actually
were they fit? Were they like,
well, I don't know them physically or personally, to be honest. There was a little bit of KFC thrown there separate, but it was a question
$9,000 on McDonald's
individually, and we had to ask the question. And I did the math, and I think we worked it out that they were spending $83 a day on McDonald's for the last 2.5 months. And we had to ask the question: Is this actual?
Mate, Warren Buffett eats a McDonald's
he does love
breakfast
his Big Macs
every day. He eats
every
a McDonald's
day.
breakfast.
And we had to ask the question, and then it ended up being verified. Now, it actually tipped the scales on them being able to access that refinance, because they looked at this as discretionary spend, and it was insane. Now, the question came saying, can you change that for at least 3 months? And we haven't finished it yet, rather, but we're on the trajectory of ideally curbing that spending to get to the point of getting that off the balance sheet and hopefully getting leaner and fitter in the same time. No one in the McDonald's space, not suggesting it's not fit, lean, but we're not sponsored by them, and maybe a little bit too much.
By the way, we're looking for sponsors. If McDonald's want to sponsor us about being fighting fit for mortgages, chicken wraps and all that sort of thing. They do a healthy option. Eat the apples; they're good. Yeah,
exactly. But I guess that was a very key point, because sometimes you don't realize what you're spending and how it actually affects that. And I guess that wouldn't have been known unless our broker team went through line by line on a P&L over the last 3 months saying, this is way too much and you can actually stop this spending and we can cut this out. We can reduce that credit card limit. And then we're in a position where we can channel your funds somewhere else because you're going to be more attractive to that bank at this point in time. That only happens after you have that conversation.
Hang on a second. $9,000 on a
$83 a day.
No, let's just break this down. Let's do this, right? For our listeners. And I'm conscious of time, but $9,000, and I'm gonna be really general here and try and throw some really basic maths out, right? At a P&I, you'd be able to service about $1.9 million bucks in debt at $9,000 a month.
$9,000. It was over 2.5 months. It was over 2.5 months.
Okay. All right.
Yeah. But 2.5 months. So let's say $4,000 a month.
$4,000 a month, right?
$4,000 a month.
That's an investment property.
Yeah. It was 130 odd bucks a day. I think I said 83 bucks. It was a bit more. It's about 130 bucks a day on
do yourself a favor, everyone. I do it every now and then because I sit there at the end of every month and I just go, where's all the money go? And you start looking at stuff, you just go, you just spend money. Everyone
Uber
does
Eats and those things. And therein lies a lot of the extra expenses that probably didn't exist 3 or 4 or 5 years ago, is that it's not just you driving to a drive-through and buying food. It's then Uber Eats adding on $5, $10, $15 if you want to express it. And all of a sudden, if you're doing that multiple times a day to your workplace, to your home, to wherever, it's all these habits that we get into. It might be multiple gym memberships, subscriptions. And I know we know all of those things where you leak money, but you do need to audit your living expenses quite regularly, because in this day and age of automation and subscription, you do get on that lazy pathway. And again, going back to where Finni really have a key focus is saying, our job is to audit your life and then ask you the question, can we get rid of this? Can we get rid of that? Can you curtail this? And all of a sudden it makes you more attractive to more banks and therefore able to get better rates, whether it's to extract equity, whether it's to get lower interest rates, whether it's to do a combination of things, continue to build your portfolio. Yeah. This is the work that needs to be done regularly.
And this notion of maximizing your borrowing or being a better borrower, so banks will accommodate your lending needs more effectively. Where you can have the most effects immediately is at the expense line rather than the revenue side. The revenue side is a bit tougher. If you're a PAYG employee, look, maybe you can get some bonuses factored into performance in your job. You can take on another job. Another big area, if you are a property investor, you can increase your rents. All these things will move the needle, but the needle will be mainly maneuvered at a debt reduction and a expense control point of view. That's where you get the more immediacy out of change and maximizing your borrowing. But go and tune into the chat I had with Eva from Finni Mortgages, finni.com.au. We're actually going to do a second part to it because it's really popular. People want to know about, okay, that's all good, but what about trust structures and all that sort of stuff, which can also be a way in which you can maximize your borrowing. Also investing in self-managed super is another thing because it's non-recourse lending. I think we had a chat recently, Paul, which is going to be coming out soon, where on your podcast, where you spoke specifically around that. So, all right, a bit long-winded, but there we have it. The call's been made. It's probably what everyone didn't want as we sort of eyeball December and the Christmas period and time off. May curb some people's holiday plans. I don't know, but according to the Westpac Bank, there's a fair few bucks kicking around in offsets. So they reckon that people are going to be able to absorb this. But let's have a look. It's a fine line. The economy walks at the moment. We want to bring inflation under control, but we don't want to stifle economic growth. That said, that's not our job. We're here to talk about it. But Paul Glossop, Finni Mortgages. Now, I know we're running up to Christmas and your team's probably getting smashed at the moment. They're happy to help right now. You'll find the time to service people if they need support immediately.
Mate, this is refi time for us. This is our job to really try to provide Christmas presents for our clients, if I'm completely honest with you. Our job is to say, okay, we've got this point in time where we want to get as much information from as many clients as we possibly can to see how we can put more presents under the tree at Christmas time. And that basically comes down to
so you're the modern version of Santa.
You're the Grinch. You're the Grinch, we're Santa.
You know what we should do for this time? Maybe this time next month, I'll come as a Christmas. You'd be surprised how many people have called me the Christmas Grinch before.
I wouldn't be.
You'd be surprised.
It must hurt your feelings, Phil.
Imagine that as a
Evidently not.
Imagine that as a parody, like actually doing a video as Phil Tarrant as the mortgage Grinch.
I reckon it'll work. Maybe next time that's you and I, mate. I'll put the hat on, you put the green suit on, and we'll head our way and figure out what we can be.
Maybe we'll do it. I'm the opposite of the Christmas drinks. I bring joy and fragility to Australian investors right across this great nation of ours. But, anyway, Paul Glossop, Finni Mortgages. Just go to finni.com.au. FINNI.com.au. Did I get that right? I know
Correct.
Sometimes stuff it up. All right. Yep. Thanks for your time. Thanks for tuning in, everyone. Look, just a real quick snapshot on the day of the rate announcement. Get back to the pub. Don't worry about it. Move on. Work it out tomorrow. That's what most people will do. Okay,
it's tomorrow's problem.
Sort it out. Tomorrow's problem.
Make it our problem. Make it Finni's problem.
Make it Finni's problem. There you go. It's really good.
Yeah.
And I'll end on this note. If it is a problem, do something about it. If it's not a problem, do something about it, because you're either going to have to be reactive to maneuver based on this because it may put stress and pressure on you, or if you have capacity and you're a property investor, it's not a bad time to buy. So use this as an opportunity. It's two ways to view any particular sort of set of circumstances or scenario. Thanks for tuning in. Remember to check out smartpropertyinvestment.com.au. You can find a podcast I did with Eva as well about maximizing your borrowing, which is super popular. That's what people want. Social media is Smart Property HQ. We'll see you again next time. Until then, bye-bye.